Hello, everybody. Welcome into Above My Pay Grade. My name is Eric, and I have a friend of mine here introduced to me by the economic ninja himself, Crypto Joe. He is an expert in charts, and I have zero to no knowledge of charts. I'm a dollar cost average guy, but I like to learn new things, and he's kind of introduced me because if you think about charts as kind of mimicking human behavior, which markets do, he does a good job of laying that out in simplistic terms. So thanks for joining me, Crypto Charts Joe or Crypto Joe. That's who you are on Twitter. Is that correct?
Right, perfect. Yeah, good morning from Texas,
Awesome. Awesome.
As if
Welcome.
you can't tell, from by my accent. Yeah.
Yeah, I talked to Joe on the phone before we started, and I knew he was from the South, and I have some roots in the South, so I love it.
Oh,
Um, but he's going to show us a couple of things on his charts, and he has a Patreon as well, which we'll introduce here at the end. But Joe, what would you say to people like myself who are kind of who think you can't beat the market through looking at charts, and who think the best strategy is to dollar cost average? Because the way I think about it is, hey, I'm not, and maybe certain people can, but I don't have the time, energy, and effort to look at charts all day, so I'm just going to dollar cost average. What would you say to people like that?
right. Well, it's been successful in the last number of years since we've been in an amazing, bull run. But I think, entering a bear market, and a lot of people, honestly, adults just coming into it, out of college, whatever, previous to that, they were used to years of a bull market. And dollar cost averaging was a way, a simplistic way to get in and have a, store of value for your money. But now in a bear market, it's really thrown people for a loop, and
Hmm.
especially people baby boomers, the early baby boomers that are now responsible for their retirement accounts, and all of a sudden, they're down 10, 15, 20, 30%. That's a pretty big hit. And if they just knew, a couple of things regarding the charts, they'd be able to kind of, scale out. And quite frankly, the reason why I know about this so well, out of several people that I've worked with in a previous career, calling me up, emailing me, going, "Hey, my quote unquote financial advisor didn't contact me, and all of a sudden, I'm 30% down,
Hmm.
and we really need this money because, inflation, everything else, that retirement account, you don't want to outlive your money, if that
Of
makes
course.
sense." Okay.
Right.
So just giving them some, tips and stuff. No, not financial advice, but hey, this is what you need to do, and then you can look at the chart. And not that we're trying to make day traders out of everyone, because 92% of the people lose money or get washed out. But we have a couple of, and that's why I call it simplistic charts or crypto charts, Joe. And the reason being, we try to make it as simple as possible because we know people, a lot of people we deal with on Patreon, YouTube, whatever, Twitter, they still have families, still have a career, and they don't have time, to look at the charts 24/7, like a lot of us. So, yeah, we have a very simple concept that they could apply, to help them what we call scale in, scale out. That's another thing. We never go into Vegas with a bag full of money and put it all on one, roll of the roulette table or whatever. Okay.
Right.
If we're going to do that, we're going to
You
kind of,
may not, but me, that's my
yeah,
master.
yeah, right. Yeah. You might not live.
Yeah.
You
Well,
know,
awesome. So he has some charts pulled up, which I will pull up in the chat here, and he's going to kind of go through kind of an intro into what he does with
Mhm.
charts. So me looking at this chart, I go, oh, I don't know what it means, but why don't you kind of explain to us that kind of simplistic style you were
Okay.
talking about?
All right. To make sure we're on the same page, can you see me squir
Moving around, yeah, yes, sir.
yeah, moving the chart around. Okay, this is the Dow Jones, just to show you how this stuff works. Before the computer, believe it or not, before the computer was even there, human nature, fear and greed, that sort of thing, and that is what plays all these markets. I mean, really, it's as simple as that. And here we have. Well, first of all, let me move back a little bit. And this was, the start of, electricity, automobiles, more, just common things around the house being invented, appliances and stuff. And so we have the roaring, 20s here. And, there's a lot of people that invest. Of course, they didn't, have, sophisticated charts like this, but we can look back and see this was generational wealth, multi-generational wealth being made, okay, which a lot of people did during the 20s. And then you had the big, sell off, and then this was multi-generational wealth being lost, okay? And you don't want to be on this side. All right, but even going back, and then markets reverse basically three different ways. You have the V-shaped recovery, which I'll show you here in a minute when we had the COVID slam down, and then you had the W shaped recovery where you have a low, higher low, and then if you get the 20 in there, and price holds that 20, like a Olympic gymnast, hitting that landing perfectly, and then continues up. That's really the strongest. That's really what you want. And then the last one is you have a lot of pain, coming down like this for an extended period, bad chart. But anyway, and then you get far and away from it, sideways consolidation. And, just like in life, something over here that was real painful, as you get time away from it, people kind of forget about it, and then the markets can come back up. Okay. And then as we see here, the worst market crash so far in, American history. You had this W, see, up, down, up, down, up, see, just like that. And then see this one, I lift that a little open so you could see it. That was the go-to candle there. So you put in a pivot low, and these pivots just a 180. You come down, you turn and move up, vice versa. So you made a low, higher low, and this closed over the 20, and then you're basically off to the races.
And
And
this is all, um, like you said, the predictability here is the human beings who are doing
exactly
the trading, not necessarily some Wizard of Oz somewhere. But
right,
yeah,
yeah, exactly. And then coming up to more recent time. Let me go to the weekly because it adds more candles here. You can kind of see it. This was the big COVID slam down, and see we V-shaped recovered out of that. And there's a few things that are, believe it or not, that are absolutes. Then I'll get to the meat of it here, and you'll see what I'm talking about. I mean, my 9-year-old granddaughter could do this. If I were somewhere, didn't have internet, I could tell her to do this. And literally, my retirement account, everything else would be stable. And I'll show you that here in a second. But let me show you this. When the 20 and the 200, now, these moving averages, you don't need a lot of stuff on your chart. The more you have, uh, the less the person really knows about trading. Okay,
hmm
because it's really just price and position and price action. But anyway, the 20 and the 200 and the 20, what that is, we're on the weekly. So this 20 is the average, the last 20 weeks average price close. Okay. And then the 200, of course, is the last 200 weeks of the average price close of that 200 weeks. When the 20 and the 200 come together, it doesn't matter if it's on this weekly chart, daily, monthly, whatever, they will separate. And of course, the 20, since it's the average of the last 20 days or weeks or months, it's going to be a lagging indicator. So price is going to lead. Okay. But anyway, when they come together, 100% of the time, guaranteed, they will separate far and away. Either price will drop to the bottom, like a market crash or whatever, and the 20 will follow down, or price will continue up and the 20 will. And the reason why I say that is that they always come back together. Okay. The last time on the Dow Jones, for example, because everybody's heard of the Dow Jones, so that's why we're using that, was in July 2020. Okay. So, and we come close to it. I don't know if that's close enough, for government work, and then we're going to separate and come back up. But if you look at it, uh, people were talking about the big us crashing real hard. Uh, we could be just in a bear market rally, so to speak, and those do happen during bear markets. You'll get a rip, 20, 30% back up to the upside, and then a rollover again. But we did come and hit the 200, which from a extend. That's another thing guaranteed from an extended price. You don't come over here and look. You go back in time. Everything you need to know about the chart is happened previously. Okay.
Hmm.
So anyway, this was the highest level above the 200. Whenever you get an extended price range above that 200, when it comes back into it, high odds, high percentage, it will soon, consolidate like it did here, or sometimes it will just hit and bounce off that 200.